In 2022, the safest money you could own had one of the worst years in its history. Not a meme stock, not crypto, bonds. The boring, grown-up, you'll-be-fine part of the portfolio, the kind of thing your dad told you to buy when you wanted to feel responsible. That year, a broad index of U.S. bonds dropped about 13%, its worst calendar year since the index began back in 1976. And here's what stunned people. Interest rates went up. That's it. Rates rose, and the price of bonds people already owned fell off a cliff. To most savers, that made no sense at all. Aren't bonds the safe thing? Don't higher rates mean more interest, which is good? That's the mechanic nobody warns you about. Bonds run on a seesaw. On one end sits the interest rate the world is paying today. On the other end sits the price of every bond already out there. When one goes up, the other must come down. It's not a glitch. It's not panic. It's arithmetic, built into how a bond works. Once you see that seesaw, bonds stop being mysterious. You'll understand why safe assets can still lose money in a year, why a long-term bond swings harder than a short-term one, and why bonds still belong in a portfolio anyway. Just doing a completely different job than stocks. So today we pull a bond apart. What it actually is, the three numbers that define every one of them, the seesaw between price and rates, why some bonds swing harder, and where they fit next to stocks. No jargon, no hype, just the mechanics. Let's start with what a bond actually is, because the word sounds fancier than the thing. When you buy a bond, you are not buying a share of anything. You are making a loan. You hand your money to a borrower, the U.S. government, a city, or a company, and they hand you an IOU. That IOU says, I'll pay you interest along the way, and I'll give your original money back on a set date. So flip the usual picture. With a normal loan, you're the one who owes. With a bond, you are the bank. You're the lender. They're the borrower. They owe you. Here's the everyday version. Say you lend the government $1,000. In return, they promise to pay you, let's say, 4% a year. That's $40 a year landing in your account just for holding the loan. That yearly interest payment has a name. It's called the coupon. Think of it as your interest check, arriving like clockwork. The name coupon is a leftover from the old days, when bonds were paper certificates with little tickets along the edge. You'd literally clip one off and cash it in for your interest. The paper is gone, but the word stuck. And this is the whole appeal of a bond. A stock might soar or crash. Nobody promises you anything. A bond is a contract. You know the interest you're owed, and you know the date you get your money back. That predictability is exactly why people call bonds the safe end of the portfolio. But, and this is the trap we're going to unpack, you get your $1,000 back on the date is only the full story if you hold the bond the whole way. Sell early, and the seesaw decides what you actually get. We'll get there. So the mental shift is simple. A bond isn't a mystery instrument. It's a loan with you as the lender, and the coupon is your interest check. Now, every bond on earth, government, city, or company, is defined by just three numbers. Learn these three and you can read any bond. Number 1, par value. This is the size of the loan, the amount you get back at the end. It's also called the face value. The standard is $1,000 per bond. So when a bond matures, you're handed that par value back. In our example, that's your $1,000 returning home. Number 2, the coupon rate. This is the interest rate printed on the bond, and it's fixed for life. Lock this word in, fixed. If the coupon is 4% on a $1,000 bond, you get $40 a year. This year, next year, every year, no matter what happens in the wider world. The borrower can't lower it. The market can't change it. $40. That fixed forever part is the key that makes the whole seesaw work. So hold on to it. Number 3, maturity. This is the finish line. The date the loan ends and your par value comes back. A bond might mature in 2 years, 10 years, or 30. Short maturities return your money soon. Long maturities make you wait. That gap is going to matter enormously in a minute. So put it together with one bond. Par value, $1,000. Coupon rate, 4%, which is $40 a year, fixed. Maturity, 10 years. Translated into plain English, that single bond says, lend me $1,000, I'll pay you $40 every year for 10 years, then give your $1,000 back. That's it. 3 numbers. How much, what rate, for how long. Every bond is just a different combination of those 3. And the most important word in the whole set is that one fixed coupon. Because the world's interest rates do not sit still, and a coupon that can't move is exactly what creates the price seesaw we're about to build. Now the main event, the seesaw. This is the part that confuses almost everyone, and it's actually simple once you see it. Go back to your bond. Par value $1,000. Coupon fixed at 4%. $40 a year. The day you bought it, 4% was the going rate. Fair deal. Now the world changes, interest rates rise, new bonds, brand new, same borrower, same 10 years, are being issued today at 6%. A fresh $1,000 bond now pays $60 a year. Yours still pays $40. It's frozen. Remember, the coupon is fixed. So here's the problem. You want to sell your old bond. Would anyone pay a full $1,000 for $40 a year when that same $1,000 buys a new bond paying $60? Of course not. Why take $40 when you can have $60? Your bond isn't worthless. It still pays $40 a year and returns $1,000 at the end. But to compete, its price has to drop. It has to fall to the point where a buyer earns roughly the same 6% they'd get on a new bond, counting both the $40 a year and the bump from buying it below face value. The coupon can't rise to meet the market, so the price falls instead. That's the only lever left. That's the seesaw. New rates up, your bond's price down. And it runs both ways. If rates instead fall to 2%, suddenly your old bond paying $40 looks generous next to new bonds paying $20. Now buyers will pay more than $1,000 for it. Rates down, your bond's price up. This is the answer to the riddle from the start. In 2022, rates rose fast. And every existing bond's price had to fall to keep up. Safe bonds lost money not because anyone defaulted, but because of this exact arithmetic. One thing to keep straight, this price swing only bites if you sell before maturity. Hold the bond to the end, and you still get your $1,000 back plus every coupon. The seesaw is a paper loss, until you sell into it. So bond prices move opposite to rates. The next question is the one that actually decides how much money is on the line. How hard does any given bond swing? Because they don't all move the same. Some barely flinch, others lurch. The word for this is duration. Duration sounds technical, so here's the plain English version. Duration is roughly how many years your money is tied up in a bond, and it doubles as a sensitivity dial. The rule of thumb the pros actually use. For every 1% that interest rates move, a bond's price moves about its duration, in percent the other way. Let's make that concrete. Take a short-term bond with a duration of about 2 years. If rates jump 1%, its price drops only about 2%. A small dip. Now a bond with a duration of about 10 years. Same 1% jump, and its price falls about 10%. 5 times the damage, from the exact same move. But here's the catch that makes long bonds even more dangerous than that. Duration is not the same as maturity. For a bond that pays interest along the way, duration is a few years shorter than its maturity. And a 30-year bond? Its duration isn't 30, but it's far above 10, often around 18. So a 30-year bond can lose roughly 18% on that same 1% rise, not 10. Long bonds swing even harder than the round numbers imply. Why does waiting longer hurt more? Because the longer your money is locked into that old, now stingy coupon, the more years you're stuck earning below the market rate. A 2-year bond frees you up soon to reinvest. A 30-year bond chains you to the old coupon for decades, so its price has to fall much further to compete. This is exactly why 2022 hit long-term bonds hardest. Rates rose sharply, and the longest bonds, the ones people thought were the safest, most patient choice, fell the most. Long-term felt prudent. Under the seesaw, it meant maximum swing. So the practical takeaway, a bond's maturity isn't just about when you get paid, it's a volume knob on your risk. Short bonds are steady and dull. Long bonds pay a bit more, but they ride the seesaw hard. Longer isn't automatically safer, it's bumpier. And one honest note, this rule of thumb is a close estimate for ordinary rate moves, a little less precise for huge ones. So if bonds can lose money, and long ones swing hard, why own them at all? Why not just hold stocks? Because bonds and stocks have different jobs. Stocks are the engine, the part of your portfolio meant to grow your wealth over decades. Over long stretches of history, stocks have delivered the highest returns, but they do it with a wild ride. Drops of 20, 30, even 40% happen. Bonds aren't the engine, they're the ballast. Picture a ship. Ballast is the weight low in the hull that keeps it from tipping over in rough seas. Doesn't make the ship faster, it keeps it steady. That's the bond's role, not rocket fuel, but stability. And to be clear, that steadiness holds best for high-quality bonds, treasuries, and investment grade. Junk bonds and very long bonds can lurch around almost like stocks. So safe assumes you're holding the calm, high-quality end. Here's how that plays out. High-quality bonds are generally far less volatile than stocks, so a slice of them calms the whole portfolio's ride. And in many past downturns, 2008, early 2020, money fled to the safety of bonds, lifting their prices right when stocks were hurting. That cushion is the whole point. Now the honest part, because this is where a lot of advice oversells it. Bonds do not reliably rise when stocks fall. That comforting negative relationship was mostly a feature of the low inflation decades, and it has flipped to positive for long stretches of history. The cushion is weakest exactly when inflation is the dominant risk, which is often when you'd most want protection. In 2022, that's precisely what happened. Stocks and bonds fell together, because rising rates hit both at once. Bonds were ballast that year that sprung a leak. So lean on bonds for steadiness, but don't count on them as a guaranteed hedge. A classic example of the balance is a 60-40 portfolio. 60% stocks for growth, 40% bonds for stability. In a normal downturn, the bond portion softens the blow, so you're less tempted to panic sell at the bottom. That emotional ballast is worth as much as the math. So the framing. Don't judge bonds by stock standards. They're not supposed to make you rich. They're supposed to keep you steady. And steady is what lets you stay invested in the growth engine long enough for it to actually work. Let's bring it together. A bond is a loan. You're the lender, and the coupon is your interest check. Every bond is defined by 3 numbers. Par value, the amount you get back, the coupon rate, the interest, which is fixed for life, and maturity, the date the loan ends. That fixed coupon is the engine of the whole thing. Because it can't move, the price has to. When new interest rates rise, your older bond paying less must drop in price to compete. Rates up, price down. When rates fall, your bond's higher coupon looks better, and its price rises. That's the seesaw, and it's why safe bonds had one of their worst years ever in 2022, when rates shot up. How hard a bond swings depends on duration, roughly how long your money is tied up. Short bonds barely move, long bonds lurch. About 1% of price movement per year of duration for every 1% change in rates. And remember, duration is shorter than maturity, so a 30-year bond swings harder than the round numbers suggest. Longer isn't safer. It's bumpier. And bonds aren't trying to be stocks. Stocks are the growth engine. High-quality bonds are the ballast. Lower returns, but far steadier, and often a cushion when stocks fall. Just don't count on that cushion as guaranteed, especially when inflation is the bigger risk. Different job entirely. The single biggest takeaway is this. Bonds only look unpredictable until you see the seesaw. A fixed coupon on one end, the world's interest rates on the other. Once you understand that one relationship, a falling bond price stops being scary and starts being obvious, just arithmetic doing exactly what it's supposed to do. If this made bonds finally click, if the seesaw between prices and rates makes total sense now, and you'll never be blindsided by a safe asset losing money again, hit subscribe. That's the entire point of this channel. The money mechanics nobody ever bothered to explain in plain English. And here's where to go next. We've now covered the 2 halves of almost every portfolio. Stocks is the growth engine, bonds is the ballast. So the natural question is, how do you actually start putting money into them, step by step, without getting overwhelmed? That's video 11, How to Start Investing, a calm beginner's walkthrough of opening an account and buying your first fund. If you're ready to go from understanding the pieces to actually owning them, watch that one next. I'll see you there.